Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Radiance Holdings Group Company Limited Annual Report. Radiance Holdings Group Company Limited offers a diverse range of businesses and services. At the core of its operations is property development in mainland China, where it develops and sells both residential and commercial properties. This includes office buildings, shopping malls, and shopping streets that are leased out to various clients. In addition to property development, the company provides management consulting services related to construction, sales, and marketing of properties, as well as project management. These services cater to the needs of developers and investors in the real estate sector. The company also offers business management and hotel services, further expanding its portfolio of offerings. With a strong presence in Beijing, China, Radiance Holdings Group Company Limited has established itself as a significant player in the property development and related services industry. Radiance Holdings Group Company Limited market capitalization of $5 billion is materially smaller than most of its industry peers of roughly $17 billion. Radiance Holdings Group Company Limited trades at a higher price-to-book ratio of 0.58 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation, signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 75% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes, such as buybacks or dividends, rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a review of the extracted summaries. Revenue decline is evident in several areas, with the most significant decrease being 42.7% year-on-year. This decline is attributed to various factors, including weak market sentiment and downward pressure on contracted sales prices in property development and sales. In particular, revenue from contracts with customers decreased by -2%, while recognized revenue declined by 42.6%. Additionally, rental income decreased by 12.6% due to lower occupancy rates and rental levels. However, there is no specific information provided on the primary drivers of this decline. On the other hand, revenue growth is evident in certain areas. Subsidy income increased by +474%, while management consulting services revenue increased by 6%. This growth can be attributed to factors such as settlement of services provided to joint ventures and associates. Regional analysis also reveals significant variations in revenue growth or decline. For instance, the Yangtze River Delta region experienced a +102.2% increase, while northwestern China saw a -0.1% decrease. These regional differences highlight the importance of considering geographical factors when analyzing revenue trends. The net income of the company underwent a significant change between two periods. Initially, it showed a loss of RMB 9,111,234, which decreased to a loss of RMB 6,919,392. However, when comparing the second period's figures, the loss increased from RMB 5,799.2 million to RMB 1,560.3 million. This indicates that despite some improvement in net income, it still remained in the negative. The profit margins also experienced a change during this time. The gross profit margin showed an improvement from -23.4% to -11%. On the other hand, the net profit margin worsened from -40.6% to -55.9%. This suggests that while the company was able to reduce its losses in terms of gross profit, it struggled with maintaining a positive net profit margin. The company's debt level has undergone significant changes in recent years. Initially, the debt increased by a substantial amount of RMB 23,468,374,000. However, this increase was partially offset by a decrease in guarantees to banks, totaling approximately RMB 5,762.6 million. Despite these fluctuations, the total debt actually decreased by 4.2% from RMB 24,602,216 to RMB 23,468,374. A closer look at the data reveals that the company's debt level has been trending downwards. The decrease in total debt is even more pronounced when comparing the 2 consecutive years, with a decline of 4.6%. This suggests that the company has made efforts to reduce its debt burden over time. In contrast to the changes in debt levels, interest expenses have not seen significant fluctuations. In fact, the total interest expense on financial liabilities not at fair value through profit or loss decreased from RMB 724,262 to RMB 694,304. This reduction indicates that the company has managed to lower its interest payments, which is a positive development for its financial health. Management's outlook on the company's future is cautious. They warn that if certain plans are not met, the company may not be able to continue as a going concern. However, they also express confidence in the company's ability to adapt to changing market conditions. In response to these changes, management has outlined its core policy directions for 2026. These include controlling new supply, reducing inventory, and optimizing supply. This suggests that the company is focused on streamlining its operations and improving efficiency. The overall trend of the real estate market is expected to be positive, with continued accommodative policy support, gradual stabilization, and accelerated industry transformation. Management's strategy appears to be aligned with these trends, positioning the company for long-term success. Concerns about inventory buildup have been raised, as evident from various indicators. The presence of "yes" on page 22 explicitly highlights this issue. Furthermore, a significant increase in provisions for inventory impairment has been noted, particularly due to the prolonged downturn in the real estate market and deteriorating consumer sentiment, as mentioned on page 34. This suggests that companies are struggling with excess stock, which can lead to financial losses and inefficiencies in supply chain management. That concludes the financial summary for Radiance Holdings Group Company Limited. Feel free to comment below, and I will be happy to answer them when possible.